So now that we've discussed a general overview of the DeFi space and the many applications within the sector, let's start talking about certain specifics. First, we'll talk about lending and borrowing. So in traditional financial systems, you may consider putting money into a savings account, and you could possibly qualify for a 0.5% interest rate on your savings. The bank can then lend that money that you put into the bank, they can lend that money to another customer at a 3% interest rate. They can take 2.5% of that rate for themselves and leave the 0.5 interest for you, the savings account owner. This is how many banks operate to this day. Now in DeFi, users are able to lend out investments directly, cutting out the middleman and earning the full 3% interest return on their money. Borrowing and lending dApps such as Compound and Aave allow you to deposit your crypto to use it as collateral, and you're allowed to borrow against it. You can also opt to deposit your crypto to lend out and earn passive income or interest on your investment. And what powers all of this is smart contracts. Smart contracts are used to ensure the security of the funds and automatically match borrowers with lenders and actively adjust interest rates based on supply and demand. To keep it short, if there's more demand for borrowers than there are lenders, there'll be more incentives for people to borrow funds, and vice versa. So let's take a visual example of what crypto loans and how they work. Starting with the left, let's say we have our borrower. This person wants to borrow money from a DeFi lending platform. So what they could do is they can deposit their crypto asset as collateral. Let's say they deposit their Bitcoin into Compound, just for example. They'll obtain a loan based on the amount that they deposit as collateral. And over time, the borrower will repay the loan back with interest to the DeFi lending platform. Once the loan is paid back, they receive their collateral. Now, to the other side of the coin, the lender. Now, would-be investors may see these lending platforms and may see the incentives that they offer, such as percentage back gained after lending after a certain period of time. So what they can do, they can deposit their crypto. In some cases, they can deposit their fiat currency. That depends from lending protocol to lending protocol. And we'll dive more into lending protocols in a later section, talking about the specifics and how they vary from one to another. Essentially, the lender would deposit their funds, and in return, after depositing it maybe for a few months or so, a few weeks, they'll receive their funds back along with interest. Now, what ensures the lender and ensures the lender that their funds are secured are smart contracts. Because if a lender lends out their crypto to a borrower, the borrower is obligated to repay their loan. Otherwise, they lose their collateral. And borrowers can only take out a certain amount of crypto based on the amount of collateral that they put into the program. And that limitation varies from lending platform to lending platform. More on that later. Next, let's talk about liquidity pools. So liquidity pool is a collection of capital locked away in a smart contract. These pools of liquidity, you can think of it as money or capital, these pools are used to facilitate decentralized lending, trading, and other dApps used in the DeFi space. So instead of central institutions providing capital for loans, smart contracts are used to distribute and collect capital for borrowers and lenders. All activities on liquidity pools are governed by smart contract code, thus removing the risk of human error and unwanted human intervention when dealing with large funds. So this is a basic example of how illiquidity would work. So essentially, lenders would deposit their assets into a pool or into a protocol, which would then act as a liquidity pool and would store all the various lenders' assets within a massive pool that is automated and essentially managed by smart contracts. No human interaction is used in the management of these funds. Borrowers are allowed to request, based on the amount of collateral that they put into the liquidity pool, they can request a percentage of their collateral back as a loan. And essentially, the liquidity pool will distribute the funds to the borrower. And at the same time, if the borrower does not repay back their loan, the liquidity pool keeps the collateral. And the lenders are always ensured that their funds are safe. Moving on to yield farming. So the use of smart contracts allows for investors to invest their capital in liquidity pools without the need of third-party oversight. As depositors invest their funds in these pools, they are often eligible for rewards based on the amount locked in the pool and the duration of the deposit. Yield farming is a process that investors profit off of the interest gained from investing in the liquidity pools. Users who deposit funds into liquidity pools are called liquidity providers. Essentially, they're providing liquidity to these funds or providing capital. These pools power applications and marketplaces that lend, borrow, and even exchange tokens. Usage of these applications incurs fees, which are then paid out to the liquidity providers based on their share of the pool. So here's a visual example of how yield farming works. So here is our lender on the left. They're going to deposit their crypto assets into a liquidity pool that the DeFi platform is based around. The borrower lends their crypto and they essentially lend out their collateral. In case they do not pay back their crypto, the smart contracts liquidate their collateral. Essentially, their collateral is kept within the liquidity pool, and essentially the lender receives interest. They yield interest over time.